On the 2nd of December, 2001, the most admired company in America died in a single sentence on a court filing in New York. Enron, $63 billion in assets, the largest bankruptcy the United States had ever seen. That morning, 20,000 people carried their working lives out of a glass tower in Houston in cardboard boxes, 30 minutes to pack. Their salaries gone, their pensions gone, because most of them had been told, again and again, to keep their retirement savings in one stock, Enron stock. And here is the part that should stop you. This was not some obscure firm that cut corners in the dark. For 6 years running, the experts had voted Enron the most innovative company in America. 6 years. The smartest people in every room said this was the future. So how does something worth more than $60 billion simply vanish in a matter of weeks? The answer is not the one the internet will give you. The answer is stranger. Search for Enron today, and you'll be told the same thing everywhere. They hid $60 billion in debt. It's a clean line. It's also not quite true. That $60 billion figure was the value of the company itself. The market capitalization that evaporated. The debt and the losses they actually buried off the books were a different thing entirely, scattered, disguised, and in some ways far more dangerous, because the whole machine only worked under one condition. It worked as long as the share price kept going up. This is the story of how Enron turned imagination into reported profit, how it hid its mistakes inside companies it secretly owned, and how a single falling stock price turned the most innovative company in America into the most spectacular fraud of its generation. It's a story about accounting, but really it's a story about a question almost nobody inside that building was willing to ask. It began in July 1985 with a merger. Kenneth Lay, an economist with a soft Missouri accent and a thick book of political connections, combined two natural gas pipeline companies, Houston Natural Gas and Internorth, into a single firm called Enron. In the beginning, Enron was exactly what it looked like: pipes in the ground, gas moving through them, steady, boring. Lay wanted more. He wanted Enron to be a company of ideas. There was a warning sign, early, about what that ambition would tolerate. In 1987, two of Enron's oil traders were caught gambling recklessly with the company's money and quietly diverting funds into fake offshore accounts. When auditors flagged it and warned the leadership, Lay had a choice. The traders were making the company millions, and so rather than firing them, he reportedly sent them a message with 3 words that would, in hindsight, define the entire culture: keep making us millions. The lesson landed. As long as you were bringing in money, the rules did not quite apply to you. The man who gave him those ideas was Jeffrey Skilling. Skilling was brilliant, intense, and absolutely certain. He had a vision he called asset light. Why own the pipelines and the power plants, heavy, expensive, slow, when you could own the trades? Enron, in Skilling's mind, would become a kind of stock market for energy itself. It would buy and sell contracts, promises, futures. It would trade the air. But to make that vision work on paper, Skilling needed a new way to keep score. And on the 30th of January 1992, he got it. The Securities and Exchange Commission approved Enron's request to use something called mark-to-market accounting. Here is what that meant, in plain language. Imagine you sign a contract to mow your neighbor's lawn for $1,000 a year for the next 10 years. Normal accounting says you earn that $1,000 each year as you actually do the work. Mark-to-market let Enron do something else entirely. It let them book the entire $10,000 as profit today, on the day the contract was signed, before a single blade of grass was cut. The future, in other words, became the present. Enron could sign a 20-year deal and report 2 decades of imagined profit immediately, and if the deal later collapsed, the profit had already been counted. The bonuses had already been paid. The clearest example of the absurdity came in July 2000. Enron signed a 20-year partnership with Blockbuster Video to stream movies on demand over its broadband network. The technology was unproven. Hollywood studios refused to license their films to it. The whole thing was a fantasy, and yet Enron immediately booked $110 million in estimated future profit from the deal. Blockbuster walked away just 8 months later. The service never worked, but that $110 million stayed right there on Enron's books, counted as money earned, profit invented out of thin air for a deal that was already dead. To feed this machine, Skilling built a culture to match. It was called rank and yank. Every 6 months, employees were graded, and the bottom slice, the lowest performers, were simply fired. The message was carved into the walls of the building. Make the numbers, or you're gone. Fear became the fuel, and it worked gloriously. The stock climbed, the magazine covers came. Fortune named Enron the most innovative company in America, and then did it again and again. 6 years in a row. Enron put stock tickers in the elevators. Its advertising slogan was a single, confident phrase. Ask why. Almost nobody did. There was a flaw at the center of all this, and it was fatal from the start. Mark-to-market accounting demanded constant, relentless growth. Every quarter, Enron had to book bigger imaginary profits than the last. But real-world investments don't always cooperate. A power plant in India lost money. A grand bet on broadband internet lost more. The gap between Enron's paper profits and its actual cash was widening into a chasm. And you can fake earnings. You cannot fake cash. So Enron needed somewhere to hide the losses. Enter the man who would build the hiding places. The chief financial officer, Andrew Fastow. Fastow's solution was elegant and poisonous. He created separate companies, special purpose entities, in the language of accounting, with strange names. Chuco in 1997. Then in 1999, 2 more named after his own wife and children, LJM1 and LJM2. The idea was simple. When Enron had a bad asset or an ugly pile of debt, it would sell that problem to one of these entities. And just like that, the debt disappeared from Enron's balance sheet. The analogy is this. Imagine you've maxed out every credit card you own, but you want a bank to give you a clean new loan. So you invent a second identity, sell your debts to that identity using money you quietly handed it yourself, and then show the bank a spotless record. Enron was, in effect, doing business with itself. The rules said this was allowed only if a genuinely independent outsider put up at least 3% of the money and stayed in control. Enron broke that rule in the most brazen way imaginable. The man controlling these outside entities was Fastow himself, Enron's own CFO. He sat on both sides of the table, and he got rich doing it, eventually pocketing around $45 million from the very partnerships meant to protect Enron's shareholders. For this to happen, Enron's board of directors had to formally waive the company's own conflict of interest rules. They did, not once, but on 2 separate occasions. The people whose entire job was to guard against this exact danger voted to permit it. One board member, looking at the obvious problem, said almost lightly, "Gosh, Andy, It sounds like you're the meat in the sandwich. And then they approved it anyway. Then came the masterpiece and the bomb. In 2000, Fastow's partnerships created 4 new entities, nicknamed the Raptors. Their job was to insure Enron against losses on its riskiest investments. But the Raptors had no real money of their own. They were backed by one thing, and one thing only: Enron's own stock. Think about what that means. It is the equivalent of buying fire insurance on your house, where the only asset the insurance company holds to pay your claim is shares in that same house. If the house burns, so does the insurer. This was the death spiral, built right into the design. As long as Enron's stock stayed high, the Raptors looked solvent, and the losses stayed hidden. But the moment the stock fell, the insurance would be worth nothing. At the exact moment Enron needed it most. There was even a written confession of sorts. Fastow and Enron's chief accounting officer drafted a secret, handwritten document that came to be known as the Global Galactic Agreement, a side deal quietly guaranteeing that Fastow's entities would never lose money on their Enron transactions. That single piece of paper destroyed the entire legal fiction. If the entities couldn't lose, they weren't independent, and the deals weren't real. It would later become the prosecution's smoking gun. And while the accountants engineered the books, the traders revealed the soul of the place. When California deregulated its electricity market, Enron's traders gamed the grid mercilessly, manufacturing artificial shortages and helping trigger rolling blackouts across the state. They were caught on tape laughing about it. At an employee meeting, Skilling reportedly joked, "What's the difference between California and the Titanic? At least when the Titanic went down, the lights were on." The room laughed. This was a company that had stopped being able to tell the difference between winning and harm. Not everyone inside was blind. Vince Kaminsky, who ran risk analysis, looked at Fastow's structures and warned, plainly, that they were dangerous and wrong. For his honesty, his team was pushed aside. The warning was filed away. The machine kept running. The first real crack came not from a regulator, not from an auditor, but from a magazine. In March 2001, a young Fortune journalist named Bethany McLean wrote an article with a deceptively simple title, "Is Enron Overpriced?" She hadn't uncovered a secret memo. She had simply read the public filings and noticed she could not understand, from the numbers, how Enron actually made its money. So she asked. Skilling was furious. The company's reaction was not to answer the question, but to attack the questioner. When Fastow spoke to McLean, he reportedly told her, "I don't care what you say about Enron, just don't make me look bad." It got worse in public. On the 17th of April 2001, during an earnings call, a money manager named Richard Grubman pressed Skilling on why Enron, alone among major financial firms, couldn't produce a basic balance sheet alongside its results. Skilling, the most confident man in American business, stumbled and then said into the open microphone, "Well, thank you very much, we appreciate it, asshole." To the believers inside Enron, it was a joke. They printed merchandise, but to the outside world, it was a signal. The management of the most innovative company in America had no calm answer for the simplest question about how it earned $1. The answer was hiding in plain sight, if anyone had cared to read it. Buried in Enron's annual report was a dense 7-paragraph passage that became known as Footnote 16, vaguely describing enormous transactions with a senior officer of the company. It was nearly impossible to decode. That was the point. The information was technically disclosed, and yet engineered to be unreadable, and the people paid to ask hard questions kept choosing not to. The credit rating agencies took executives at their word. The stock analysts kept their buy ratings on the day Enron announced a billion-dollar charge that October. 15 out of 15 major analysts still rated it a buy because their banks wanted Enron's business. One analyst, pressed by the short seller James Chanos, simply shrugged and admitted, "Look, this is a trust me story." And the SEC, having approved mark-to-market back in 1992, had not reviewed a single one of Enron's annual reports since 1997. Then the believers themselves began to run. On the 14th of August 2001, Jeffrey Skilling, the architect of all of it, the true believer, abruptly resigned as CEO. Personal reasons, he said. He had been in the job a matter of months. The very next day, an Enron vice president named Sharon Watkins sat down and wrote a memo to Ken Lay. It did not hedge. "I am incredibly nervous," she wrote, "that we will implode in a wave of accounting scandals." She had named it exactly before it happened. Lay's response was to have the company's own law firm look into it, the same firm that had blessed the deals in the first place. From there, it took just over 70 days for the whole thing to fall. On the 16th of October 2001, Enron reported a $618 million loss for the quarter, and quietly disclosed something far worse buried beneath it, a $1.2 billion reduction in shareholder equity. The Raptors had failed, exactly as their design guaranteed. The stock was falling, so the insurance was worthless, so the hidden losses came roaring back onto Enron's own books. 6 days later, on the 22nd of October, the SEC announced an inquiry. The stock dropped 20% in a single day. And as investigators began to circle, Enron's auditor, Arthur Andersen, one of the most prestigious accounting firms on earth, made a choice. In its Houston office, employees began to shred. Tons of documents fed into the machines, tens of thousands of emails deleted. The shredding ran for weeks and only stopped when an assistant to the lead auditor sent a single, urgent line. "Stop the shredding. We have been officially served for our documents." Why would they do this? Because Andersen had been compromised for years. In 2000 alone, Enron paid the firm $25 million for auditing and $27 million for consulting. The auditor was financially addicted to the company it was supposed to be policing. Meanwhile, Ken Lay was lying to his own people. In late September, at an online forum with terrified employees whose savings were trapped in Enron stock, he told them the third quarter looked great, and that, in his words, Enron stock is an incredible bargain at current prices. He said he was buying. He was at the same time quietly selling around $24 million of his own shares. By late November, Enron was out of cash and out of time. Its last hope was a rescue merger with a smaller Houston rival, Dinegy, worth $8 to $9 billion. But when Dinegy's people looked closely at the books, they saw the rot. On the 28th of November, the rating agencies finally cut Enron to junk, and Dinegy walked. Its CEO later summed up what they'd found in a single devastating line. "At the end, you couldn't give it to me." The stock crashed to 61 cents. 4 days later, the filing in New York, and the boxes on the sidewalk. The reckoning came slowly. Arthur Andersen, 89 years old, was convicted of obstruction and destroyed. 85,000 jobs gone worldwide. The Supreme Court would overturn that conviction in 2005, but by then there was nothing left to save. The Sarbanes-Oxley Act of 2002 rewrote the rules of American corporate honesty, forcing CEOs to personally sign for the truth of their numbers. For the employees, there was no such rescue. Around 20,000 lost their jobs, and an estimated $2 billion in pensions and savings evaporated, much of it frozen in Enron stock they had been forbidden to sell as the price fell to nothing. Years later, a class action lawsuit against the banks that helped build the fraud would claw back a $7.2 billion settlement for shareholders, a fraction of what was lost, and far too late for most. Andrew Fastow, the architect, cooperated and served 6 years. Jeffrey Skilling was convicted on 19 counts and sentenced to 24 years, later cut to 14. Kenneth Lay was found guilty on every count he faced, and then, on the 5th of July 2006, before he could be sentenced, he died of a heart attack. Under the law, because he died before his appeal, his convictions were erased as if they had never happened. There is one final irony. Andrew Fastow, the man who designed the hiding places, now travels the world as a paid speaker on corporate ethics, lecturing business students and compliance officers on exactly how a smart executive talks himself into crossing the line. He, at least, understands the machine from the inside. But look again at that headline, the one that says they hid $60 billion in debt. The truth is both simpler and more unsettling. The $60 billion was never hidden in a vault. It was the value of a company that in the end existed mostly in the imagination, in profits that hadn't been earned, in insurance that couldn't pay, in a stock price that everyone agreed to believe in until suddenly they didn't. Mark-to-market was, in the end, a way of writing down a dream and calling it cash. The smartest guys in the room had built a machine that ran on nothing but confidence. And confidence, unlike a pipeline, cannot be repaired once it breaks. 7 years later, with different names and the same blueprint, Wall Street would do it again.